Picture the scene. It's last night. New Year's Eve, 2025. Mar-a-Lago is lit up like a Roman candle. The champagne is flowing, the black ties are out, and the music is blaring. President Trump is working the room, celebrating the arrival of 2026. But while the fireworks were going off outside, a silent document was sliding across a desk in Washington, D.C. that just saved the U.S. economy from a massive heart attack this morning. We were hours, literally minutes, away from a supply shock that would have sent the price of home renovation and construction into the stratosphere. We were staring down the barrel of a 50% tariff on kitchen cabinets and a 30% levy on furniture. If you thought inflation was sticky before, this would have been the gasoline on the fire. But then, the White House blinked. At the 11th hour, a fact sheet dropped. No press conference. No fanfare. Just a quiet admission that the American consumer is tapped out. The administration has delayed these massive tax hikes until January 1, 2027. Why does this matter to you? Because this isn't just about sofas and plywood. This is the first major signal in 2026 that the political cost of inflation has finally outweighed the desire for protectionist flexes. It's a signal that the trade war 2.0 is hitting a wall, the wall of your wallet. If you hold Home Depot stock, if you're looking at real estate, or if you're just trying to figure out why your dollar feels like it's made of monopoly money, you need to pay attention. The administration just kicked the can down the road for exactly 1 year. Today, we are peeling back the layers of this midnight reprieve. We're going to look at why the Reshoring Miracle is failing, why the housing market is on life support, and exactly how you should position your portfolio before the clock runs out on this 1-year truce. Let's get the facts straight before we dissect the money trail. Under a proclamation made back in September 2025, the administration set a ticking time bomb. The plan was aggressive: take the existing 25% tariffs on specific wood products, think your upholstered sectionals, your kitchen vanities, the stuff that makes a house a home, and crank them up. Furniture was going to hit 30%. Kitchen cabinets? A staggering 50%. That was supposed to happen today. If that order had gone through, every contractor in America would be rewriting their quotes this morning. Margins for retailers like Wayfair, Williams-Sonoma, and Lowe's would have evaporated instantly, or more likely, been passed directly to you with a markup. But the White House pulled the emergency brake. The official reason? Productive negotiations with trade partners. They claim they are working on reciprocity and national security concerns. Translation? That is diplomatic speak for, the voters are angry, and we cannot afford a price spike right now. We have to look at the political calendar. It is 2026. We are heading into the midterms later this year. The voter frustration mentioned in the reports isn't just a footnote, it's the driving force of economic policy right now. The administration knows that if the price of a kitchen remodel jumps 20% in Q1 of an election year, they are toast. So, the 25% tariff stays. The hike to 50% is pushed to January 1, 2027. But don't mistake this delay for a solution. This is the classic Washington kick the can strategy. They haven't fixed the supply chain. They haven't solved the trade deficit. They have simply bought time. And in the world of finance, time is the most expensive commodity there is. This delay proves one thing: the US consumer is at a breaking point. The pricing power that corporations bragged about in 2023 and 2024? It's gone. You can't squeeze blood from a stone, and you can't squeeze more margin from a middle class that is already drowning in credit card debt. Let's zoom out. Why is the President of the United States micromanaging the price of ottomans on New Year's Eve? Because we are living through a terrifying economic echo of the 1970s. If you study economic history, you know about the Arthur Burns mistake. Burns was the Fed chair in the 70s who famously let inflation run hot because of political pressure, only to see it come back with a vengeance. We are seeing a modern remix of that right now. For the last 2 years, we've been told the battle against inflation is entering the final phase. Yet, here we are in 2026, and prices are still simmering. Why? Because tariffs are, by definition, inflationary. When the government slaps a 50% tax on imported cabinets, the Chinese or Vietnamese exporter doesn't write a check to the US Treasury. The importer pays it. The importer, let's say a major distributor in the Midwest, then has two choices: eat the cost and see their stock price crash, or pass it to the consumer. By delaying this hike, Trump is essentially admitting that the Fed's interest rate hikes haven't cooled demand enough to absorb a supply shock. This is critical for your portfolio. If the administration had let these tariffs rip today, we would have seen a massive spike in the CPI next month. That would have forced the Federal Reserve to keep interest rates higher for longer, or maybe even hike them again. By delaying, they are trying to engineer a soft landing for the 10th time. But here is the catch: by keeping the existing 25% tariffs in place, they ensure that prices won't go down. They just won't go up as fast. This is what economists call cost-push inflation. It's not about too much money chasing too few goods anymore, it's about the structural cost of doing business rising due to geopolitical friction. As an investor, you need to understand that this delay is actually a signal that inflation is going to remain sticky around 3% to 4% for the foreseeable future. The government is terrified of it going to 6%, but they have no tools to get it back to 2% without removing the tariffs entirely, which they won't do for political reasons. We are stuck in the stagflation-like trap. Growth is slowing, but prices remain elevated. This is the worst possible environment for cash, which is why you see assets like gold and even Bitcoin holding value. The dollar is losing purchasing power, not because of the money printer this time, but because of trade barriers. Now, let's connect this to the asset class that makes up the bulk of American wealth, housing. The housing market in 2026 is a weird beast. Mortgage rates are still uncomfortable, inventory is low, and affordability is at record lows. The sector that has been keeping the housing market somewhat fluid is renovation. People can't afford to move and swap their 3% mortgage for a 7% one, so they renovate. They fix the kitchen. They buy new furniture. They finish the basement. The remodeling index has been a key indicator for the economy. If Trump had allowed that 50% tariff on kitchen cabinets to hit today, it would have decimated the remodeling market. Think about the leverage here. A kitchen remodel can easily cost $50,000 to $80,000. Cabinets are usually 30 to 40% of that budget. If the material cost of those cabinets spikes by half, projects get cancelled. Contractors get laid off. The velocity of money in the local economy screeches to a halt. This reprieve saves the Q1 and Q2 earnings for companies like Home Depot, Lowe's, and Sherwin-Williams. If you look at the pre-market trading this morning, I guarantee you'll see relief rallies in these tickers. Wall Street was pricing in a disaster, instead, they got a hall pass. But there is a darker side to this. This focus on wood products and vanities tells us that the US domestic supply chain is failing to launch. The argument for tariffs, going back to 2018, was always protectionism will bring factories back to America. We were supposed to see a boom in American furniture manufacturing in North Carolina and Michigan. So, where is it? If American factories were roaring and ready to supply the market, the White House wouldn't need to fear a tariff hike on imports. The fact that they are terrified of the price spike proves that we are still addicted to imports. The Reshoring Miracle is taking much longer than promised because of labor shortages and environmental regulations. This puts real estate investors in a bind. Construction costs remain high because materials are taxed, but domestic alternatives aren't scaling fast enough to lower prices. If you own rental property, your maintenance costs are permanently higher. Replacing a broken vanity or swapping out a sofa in a furnished unit costs 30% more than it did 4 years ago. This eats into your cap rate. The delay today prevents it from getting worse, but it doesn't fix the margin compression you're already feeling. We need to talk about who is on the other side of this table. The fact sheet mentions productive negotiations with trade partners. Who are we talking about? Primarily China, but increasingly Vietnam, Malaysia, and Mexico. This is the failure of the China plus one strategy. For years, companies moved production from China to Vietnam to avoid US tariffs. But the US government caught on. They realized the Chinese companies were just setting up shell factories in Vietnam, slapping a Made in Vietnam sticker on the cabinet, and shipping it to Long Beach. The threatened 50% tariff was a weapon designed to stop this transshipment. By delaying it, Trump is essentially saying, we know you're cheating, but we need your cheap goods right now. It's a moment of incredible geopolitical irony. The America First agenda is colliding with the reality of the American consumer's wallet. But look closely at the wording, national security concerns with respect to imports of wood products. Since when is a coffee table a national security threat? This is where the narrative gets interesting. It's not about the wood. It's about leverage. The US is likely using these suspended tariffs as a bargaining chip for something bigger, semiconductors, rare earth minerals, or battery technology. Trump is holding a gun to the head of the furniture industry to get concessions in the tech sector. It's 4D chess, but the pawns are American homeowners and small business retailers. For the global markets, this delay suggests that 2026 might see a temporary thaw in trade tensions. If the US is willing to back down on this, they might be willing to negotiate on EVs or solar panels. This is bullish for emerging markets and international shipping stocks, which rely on the flow of goods remaining unobstructed. Let's get tactical. Who wins and who loses from this one-year delay? The winners. 1. Big box retailers, as mentioned, they dodge a bullet. Their inventory costs stay stable-ish for 2026. 2. The middle-class consumer, you get one more year to finish that renovation before the prices potentially skyrocket in 2027. 3. Logistics companies, a sudden tariff spike usually causes a drop in volume as orders are cancelled. Stability is good for freight volumes. The losers. 1. Domestic manufacturers, the small furniture shops in the US who were banking on their foreign competitors getting slapped with a 50% tax just got rug pulled. They can't compete on price with Asia without that tariff wall. Expect some bankruptcies in the US manufacturing sector this quarter. 2. The US dollar, tariffs tend to strengthen the dollar. Delaying tariffs might soften the dollar slightly, which which is actually good for US exporters but bad for your European vacation plans. Watch out for companies that are heavily leveraged. This delay is temporary. If a company has a business model that requires cheap imports to survive, they have an expiration date of January 1, 2027. They have 12 months to pivot their supply chain or die. I'm looking at discount retailers and fast furniture brands. If they don't diversify their sourcing away from the targeted nations by next year, they will be crushed when the delay expires. So, what happens on January 1, 2027? We are setting up for a fiscal cliff scenario. Scenario A, the deal. The productive negotiations actually work. The US signs a trade pact, maybe extracting promises on intellectual property or currency manipulation. The tariffs are permanently scrapped or reduced. This is the Goldilocks scenario: markets rally, inflation cools. Scenario B, the bluff called. Negotiations fail. The midterms pass, the political pressure eases, and Trump drops the hammer in 2027. We see a 50% overnight price hike. Inflation roars back, the Fed panics, and we hit a hard recession in 2027/2028. Scenario C, the forever war. The tariffs are delayed again. And again. We enter a period of permanent uncertainty where businesses stop investing because they don't know what the tax rate will be next year. This is the Japanese stagnation route. My bet? Scenario B is the most dangerous. Politicians rarely solve problems, they delay them until after elections. Once the votes are counted in November 2026, the incentive to protect consumer prices evaporates. The administration will pivot back to tough on trade rhetoric to secure their legacy. This means you have a 12-month window. 2026 is the eye of the storm. So, how do you play this? 1. Front-load your consumption. If you have been planning a capital expenditure, renovating a rental property, buying furniture for a new office, upgrading your home, do it in 2026. Do not wait for 2027. The risk to the upside on prices is too high. 2. Watch the retailers. Keep an eye on the earnings calls of companies like Wayfair and RH. Listen to their guidance. Are they talking about supply chain diversification? If they aren't, sell the stock. They are sleepwalking into a buzzsaw. 3. Hedge against inflation. The fact that the government had to intervene to stop a price spike proves the system is fragile. Keep your allocation to hard assets, real estate, commodities, and blue-chip companies with pricing power intact. The dollar is being managed for political optics, not economic soundness. 4. Don't fight the Fed. Or the president. Right now, the administration wants markets to stay calm for the election year. Expect stimulus, delays, and good news drops like this one to keep the S&P 500 propped up. But remember, artificial stability usually precedes real volatility. The White House just bought us a year. They kicked the can. But eventually, we're going to run out of road. Make sure you're ready when we do. Thanks for watching. If you want to see my deep dive on which specific housing stocks are most exposed to the 2027 cliff, check out the video on the screen right now. And as always, watch your portfolio, because Wall Street never sleeps.